Welcome to the deep dive. Trying to make sense of complex financial reports can sometimes feel like drinking from a fire hose.
It really can. So much data.
Exactly. So today we're wading into MSCI's latest quarterly earnings, Q2 2025 specifically. Our mission, cut through that noise. We want to pull out the most crucial insights, maybe some surprising facts, and really get you the info you need to be truly well-informed about this global giant.
And it's worth saying, this isn't just about, dry numbers on a spreadsheet. MSCI is, well, it's like a key part of the plumbing for global investment.
Right.
Their results give us this fascinating window into how money's moving around the world, what strategies are working, how investors are thinking.
So it's the why behind the what.
Precisely. Why it matters for the bigger financial picture and ultimately for you.
Okay, so let's open the book, shall we? Let's unpack MSCI's Q2 2025. Seems like a pretty robust quarter overall.
Definitely robust, especially given, the market conditions.
Yeah. So the headline indicators look strong. Revenue growth, over 9%?
Right.
Operating revenues hit $772.7 million.
And organic growth was strong, too, 8.3%.
Right. And then adjusted EBITDA up over 10%. Adjusted earnings per share, EPS, that climbed almost 15%.
Pretty impressive jumps.
Yeah. And free cash flow, a really substantial number, over $300 million, 301.575 million to be exact.
That's a lot of cash generation.
It is. And it seems like they're confident too, right? They repurchased $286 million of their own shares so far this year.
At an average price around $557, yeah, that signals confidence in their own value.
So what's really driving this?
Well, what's fascinating here, I think, is the resilience of the growth. It's not just growth, it's stable growth.
Okay.
The revenue increase came from two strong sources. Recurring subscription revenues, they were up $41.3 million.
Okay, the steady stuff.
Exactly. And also higher asset-based fees, which added another, $20.8 million.
So good mix.
A very good mix. And their run rate, their estimate of annualized recurring revenue, that grew 10.7% overall.
And that run rate figure, that's important because...
Because it points to a sticky, growing client base. It gives them really good visibility on future revenue.
Yeah.
Stability.
Got it. Okay, so let's zoom in on the index franchise, because that seems to be where MSCI is just such a powerhouse.
Oh, absolutely. The numbers here are, well, they're pretty staggering, frankly.
So they hit record AUM assets under management levels in ETFs linked to their indices.
Record levels, yeah.
And the asset-based fee, the ABF run rate, surged 17%. That led to their highest ever quarterly ABF revenue.
Think about that highest ever. Shows the power of those asset flows.
And get this. Apparently, MSCI captured more indexed equity ETF cash flows than any other index provider during the quarter.
That's a huge win, market share gain.
It really is. The scale is almost hard to wrap your head around.
Yeah.
Total equity index ETF AUM linked to MSCI. It went over $2 trillion for the first time.
$2 trillion just in those equity ETFs.
Yeah, $2,024.6 billion. But then if you look at all the AUM tracking MSCI indices, ETFs and non-ETFs, a staggering $6 trillion.
Wow. Okay, that's infrastructure level.
Right. And fixed income index ETFs are smaller, but still significant at $84 billion.
Still a big number.
And they're not just sitting back, right? They launched new products, things like constituent AUM and index liquidity data sets, deeper insights.
Right, adding more value around the core indices.
So if we connect these huge numbers to the bigger picture, what does it tell us?
It tells us just how vital MSCI indices are for global investing, especially, for getting exposure outside the U.S. markets.
Okay.
That $6 trillion isn't just a number. It shows this massive trend, capital flowing into passive rules-based strategies and international diversification. MSCI is kind of the highway for that.
The essential infrastructure.
Exactly. And you see it in their client growth, too. Wealth managers were leading the pack, 16% growth in index subscription run rate.
Okay.
Hedge funds next at 14%, banks at 12%, asset owners at 9%.
So broad-based demand.
Very broad. Even active asset managers who are, under pressure as a sector, they still grew just under 7%. Steady.
And what about the flows from U.S. to international? You mentioned that.
Yeah, that's been a huge boost, as they put it, for their asset-based fees. And it's likely creating more demand for subscriptions, too, because they're already so embedded.
Makes sense. What about custom indexes? I hear a lot about those.
Yeah, demand there is still strong, though subscription sales slowed just a little bit this quarter. But they still signed a large deal with a U.S. bank for ETF-linked custom index data. So still very active.
Okay. And this raises an interesting point.
Yeah.
What about active ETFs? That seems to be a growing area.
It absolutely is. And MSCI sees it as a, quote, significant growth opportunity.
Are they involved?
Oh, yeah. They're already playing a big role. They have 50 clients globally using their stuff for active ETFs, with about $10 billion in AUM already.
Wow. Okay.
The whole industry is kind of shifting, from mutual funds to these active ETFs. And MSCI is right there helping firms build the quantitative strategies behind them.
So their data and tools are key for that transition.
Very much so. It's a potentially very beneficial trend for them.
Okay, so indices are clearly the star, but MSCI is more than just indices, right?
Yeah.
They leverage that data across other solutions.
Exactly. Their strength is also in that breadth.
Let's talk about some of those other areas. Analytics tools, for instance. They mentioned those proved valuable during market volatility.
Right. When markets get choppy, good risk and performance analytics become crucial. And they actually had their highest ever Q2 for recurring sales and analytics.
Really? Driven by what, mainly?
Mostly by their equity risk models. Lots of demand there.
And they also mentioned a big deal for MSCI Wealth Manager.
Yeah, their largest ever deal, apparently. A 7-figure deal with a major U.S. regional bank.
So what does that Wealth Manager tool do?
It's basically a unified solution for banks and wealth firms. Helps with model construction, creating personalized portfolios, even regulatory support. It ties a lot together.
Interesting. So it connects different pieces.
That's what's really exciting about MSCI, I think. Their ability to synthesize all this diverse information and connect the dots across different parts of the investment world.
It's not just siloed products.
No, it's a multi-pronged strategy, shows they're adaptable. And you see that in the different growth rates, like analytics subscriptions up 8.3%. They're meeting different needs, multi-asset solutions, deep equity analytics.
And who's driving that analytics growth?
Banks, broker-dealers, hedge funds, they're really important clients there. And they're also focusing innovation on fast money investors.
Fast money, you mean like high-frequency traders?
Yeah, exactly. Quants, HFTs, they need the best equity models, real-time risk insights, super low latency data. That's a key area for MSCI's tech focus.
Okay, shifting gears a bit. Private assets. MSCI called this an attractive long-term opportunity.
And the growth shows it. Nearly 13% run rate growth in Q2.
And they launched something called MSCI Asset and Deal Metrics.
Yeah, that sounds pretty powerful. Data from over 26,000 private equity deals covering, get this, $2 trillion in net asset value.
Wow. That's shining a light on a very opaque market.
Exactly, bringing transparency.
What about real assets? Sounded a bit tougher there.
Yeah, new recurring sales were described as challenged, but they are innovating. New products for commercial real estate, like a data centers product, and something called RCA funds.
RCA funds.
Yeah, an intelligence offering covering over 8,000 real estate funds. So still pushing forward despite challenges.
And finally, sustainability and climate. ESG, how's that doing?
Well, they mentioned a cyclical slowdown, which isn't surprising given some market pullback, perhaps.
Still important.
Oh, absolutely. They said these tools are now a permanent feature of investing. And the numbers back it up. Strong subscription run rate growth, 10.8%.
So embedded now.
Precisely. It really shows they're committed to, future-proofing the business. Demand for climate and ESG data isn't going away. It's becoming standard practice.
Yeah.
And MSCI wants to be the key provider there.
Makes sense. Okay, let's peek behind the curtain a bit. Operations, management, how are they handling all this growth?
Good question. Let's look at expenses.
Total operating expenses were up 6.8% in Q2. What drove that?
Mainly compensation and benefits, partly due to hiring, adding headcount strategically, but also some severance costs and higher IT costs too, investing in tech.
Okay. But interestingly, general and admin expenses, G&A, actually decreased by 3.4%.
Yeah, that was partly due to an accounting adjustment, something about the fair value of contingent consideration linked to an acquisition, Fabric.
Okay, so maybe a bit of a one-off factor there.
Could be. But a crucial metric for them is always the retention rate.
Right. How many clients stick around? What was that?
Very strong. 94.4% total retention rate in Q2.
That's high. Says a lot about client loyalty, doesn't it?
It really does. Shows how sticky their services are. Which, raises the question of how they maintain all this, keep the finances solid.
Right. How's their balance sheet looking? Liquidity.
Exceptionally robust, seems like. They rely on cash from operations, their existing cash pile, and credit facilities. Plenty of resources.
Any key ratios?
Yeah, their consolidated leverage ratio was 2.24 to 1, very healthy. And the interest coverage ratio was even stronger, 10.70 to 1.
So easily covering their debt payments.
Easily. And these aren't just abstract numbers. This strength gives them strategic flexibility.
Like for acquisitions.
Exactly. Like Fabric RQ or Foxberry, which they also mentioned buys that boost their tech or index capabilities, or lets them return capital to shareholders efficiently. It underpins that long-term stability.
And internally, they seem focused on alignment, too. Mentioned stock ownership guidelines for execs and directors.
And clawback policies. It's all about aligning management interests with shareholders, building trust, ensuring that long-term vision stays on track. Good governance.
So wrapping this all up, what's the big takeaway here for our listeners? What does it all mean for you?
Well, I think we've seen MSCI isn't just, churning out numbers. They're demonstrating a really clear strategic expansion.
Yeah, across global investment, data, analytics, they're involved everywhere.
Right. Powering the ETF boom, adapting to what wealth managers need, innovating in tricky areas like private assets. Their influence on how the world invests is just, undeniable.
Definitely clear.
And if we connect this back to the bigger picture, this deep dive really shows a company navigating a pretty dynamic market with real strategic skill. The trends we talked about, assets moving internationally, the rise of active ETFs, these are major tailwinds for them. It really solidifies their role as like that foundational layer for global markets.
So a final thought for people to chew on.
Yeah, here's something interesting to consider. As all this investment data and indexing gets even more integrated, even more sophisticated, how might that change things for the everyday investor?
You mean like accessibility,
Yeah.
personalization?
Exactly. How might it impact the kinds of financial products available to you and how tailored they can become in the coming years? Something to definitely mull over as you keep exploring the world of finance.